I hope you had a relaxing Memorial Day weekend. There has been a lot of noise this week, from the Fed drama to confusion about the tariffs. And here's the simplified rundown. We can start with Trump and Powell's private meeting. That happened this week. It was actually their first sit down since the election. And let's just say it wasn't exactly warm and fuzzy. Trump reportedly pushed Powell hard for rate cuts. And the last time we got cuts during an inverted yield curve, mortgage rates actually didn't move, but that was kind of different circumstances. Today, the yield curve's steepening, and that steepening basically means a cut could actually help this time around. And all that steepening really means is, the gap between short-term interest rates, like a 10-year Treasury yield, and long-term rates, like 30-year yields, are getting bigger. And in a normal market, long-term rates are higher than short-term rates, and investors, reasonably expect to get paid more for tying up their money for longer. And over the past couple of years, we had what's called an inverted yield curve, where short-term rates were actually higher than long-term ones. And now that long-term rates are, rising faster than short-term ones, or, short-term rates are falling while long-term stay steady, the curve is steepening. And in other news, Lacey Hunt, he's a very well-respected economist, said that the Fed is about 1% too restrictive right now, and it's putting unnecessary pressure on growth. He expects unemployment's going to hit 5%, which would almost force the Fed to make a cut. And he also made an interesting point, saying that he doesn't think, tariffs are actually inflationary. He said the costs are often absorbed by importers, and if anything, they might actually be deflationary. We also got the PCE inflation report for April. That's the Fed's favorite measure for inflation. Came out today. It was a good report, and it came in as expected. Core inflation is likely still overstated. If we adjust shelter costs for more real-time numbers, like the actual numbers we're seeing on Zillow or Apartment List, we'd be closer to the Fed's target. And that shelter number is still the biggest inflation driver, but it's continued to lag behind, and it isn't seeming to catch up very fast. Rent growth is slowing, but the Fed's still working off those lagging numbers that I mentioned, and it's making things look worse than they actually are, and it's keeping rates from coming down. Now remember, mortgage rates do move with inflation, and on the consumer side, incomes did jump more than expected, but it looks like that was mostly because of adjustments to Social Security. But spending barely moved, and we also saw a slowdown in GDP, another sign that the economy is slowing. And when the economy does poorly, it's actually good for mortgage rates typically. Tariffs and trade headlines are still flying around, so I'll keep an eye on that and update you when there's meaningful news. But the bottom line is inflation is cooling, even though the numbers don't show how much improvement we've seen, at least in other reports. And the job market's continuing to soften, and the Fed is under pressure. All these things could lead to Fed cuts and improved mortgage rates, but don't expect big moves yet. But the numbers are looking better if you're hoping for lower rates. Next week, we're going to be watching the JOLTS jobs report. That's job openings and labor turnover. Tuesday, we're going to get the ADP report, and then Friday is the big BLS report. That's going to be the big one. So I'll see you in a week. Have a great weekend.